Yo, my people, I welcome all of you once again to my channel. If this is your first time watching my video, consider subscribing because on this channel, I always deliver my best. Yes, in my previous video, I elaborated on the buyer side liquidity and I walk you through how to locate the various examples of buyer side liquidity. Now, in this video, I'm going to walk you through the sell side liquidity, which is the brother of buy side liquidity. And sell side liquidity is an example of an external range liquidity. As institutions trade in the markets, they always leave their footprints, watermarks, landmarks in the market in the form of liquidity. And liquidity simply means money or cash. It can also mean buy and sell orders. So in the market, price always goes to where liquidity is located. Yes, so follow me closely as I walk you through. So we are going to look at the first example of sell side liquidity. Great. Our first example are lows and bottoms. And when you go into detail, we have equal lows. That's where the two lows are of the same level. Double bottoms, triple bottoms, multiple bottoms. So on this note, I would like to send you to the charts so that I'll help you to locate these bottoms and lows. Yeah, this is one typical case study of equal lows or bottoms. By looking at it carefully, the lows are not of the same level, so I'll name it relative equal lows or relative double bottoms. Alright, we also have another case study here. Though this very candle, which is our liquidity pool, went too low, but on average, here was our double bottom formation. We again have a very interesting equal lows here, or equal bottoms or double bottoms, whatever way you call it. At my far left, the same rejection took place here at the equal low price level. So we can say there was a multiple equal lows here or multiple bottoms. Yes, let me mark it. So these are multiple equal lows here. Let's look for more case study. Here is our multiple equal lows at our level of interest. Yeah, looking at this discount level, we had a relative double bottom formation because the lows were not of the same level. So this is a typical example of relative double bottom. They happen all the time. Another example is here, relative double bottom. So anytime you spot relative double bottom or equal lows, multiple bottom, triple bottom, know that price will definitely turn its direction. How you see, you have equal lows here, despite the fact that this candle went far below, but we had our equal lows or double bottom formation after price cleared. At this very level of interest, you could see price made a momentum swing high all the way to the premium zone. So that's how it is. Liquidities are always located at the equal lows, double bottoms, triple bottoms, multiple bottoms levels. Yeah, so I will take you to the second examples of sell side liquidity. So the second example of sell side liquidity has to do with PDA, which stands for Premium Discount Arrays, consisting of bullish order blocks at the discount level, mitigation breaker, flip line, also known as equilibrium line. So all these three terms mean the same thing. It is a line that indicates the break in market formation and also where support tends to resistance and resistance also tends to support. On this note, I would like to send you to the markets so that I will help you locate them Yeah, so I'm going to start with the bullish order block, which is the last bearish candle at the discount level. So looking at this trend, the last bearish candle before the up move was this very one. So I'll mark it, targeting the lower wick, then extend the zone to the right. So meaning the whole of this zone was our bullish order block zone. As you can see, as soon as price left this zone, it got rejected at exactly the bullish order block zone, tapped some liquidity, then made a momentum swing high. They are common in the market, the last bearish candle before the up move. So this one too is a typical example of bullish engulf order block. They happen all the time. Let's look at the high probability ones. This is another typical case study. Last bearish order block. Yes. So the whole of this zone was our bullish order block level. As price left the zone, it got rejected at the equal highs here, got some liquidity, then came down for the retracements, and then as soon as it got liquidity down below, then it made a bullish move. Yes, so in future you could see price violated the bullish order block zone here and later on made the retracements, tap some liquidity, then it continued its direction. This is another typical example, the last bearish order block before the up move at the major discount level. So the whole of this zone was our bullish order block zone. As price left the zone, it came back for a rejection. After tapping liquidity, then it went bullish. So this means that the best zone to enter your trades is your order block zones. I mean high probability order block zones, which are located at the major premium and discount levels. That is where you take your high probability trades, which give you good risk reward ratio, leading to big profits. Yeah, so it happens all the time. Another example is here, the last bearish for the up move. You could see future price came back for another liquidity, went below, came back, then finally continued in direction. So it is always good to enter your positions at the major zones where high probability order blocks are located. Moving forward, I will show you the mitigation breaker where we have our flip line and equilibrium line. Examining this level very well, this is where we had our breaking market structure, but before then, this side of the market, this line served as the support for price to go bullish, and in future price violated the flip line because yeah, breaking market structure happened. So in future price came back for a rejection at this level of interest, and at this time the line served as resistance for price to go bearish. So this very particular line is called flip line because support is flipped to resistance, and then it is also called an equilibrium line or break in market structure or mitigation breaker. Let's look for more case study. Yeah, you also have a very interesting flip line here. Looking at this very zone, let me map it for you to see. Yeah, so this is our flip line. At this side of the market, the flip line served as support for price to go bullish, and in future price violated this very line and then later on came back, consolidated through it, and then got support again and went bullish. In future it traded to it, got support, went up and cleared old highs here, then violated it once again. Then in future the level became resistance for price to go bearish. So in a nutshell, at this very moment, this is where break in market structure happened, and then consolidation happened here, and then again break in market structure happened here. Yes, the line served as support for price, then this one break in market structure happened, the line served as a resistance for price. So this is a typical example of a flip line where support tends to resistance and resistance tends to support. Again, this line also known as equilibrium line or mitigation breaker, because mitigation breaker means break in market structure. Yes, so my people, this is how we locate our sell side liquidity in the markets. Very easy to spot. Yes, so if you have any question concerning the sell side liquidity, you can leave your comments in the comment section so that I will reply them in due course. On this note, I would like to sign out here. See you in my next video. I love you all.